Good afternoon. This is Craig Model Mike live from Lawrence, Kansas this week with the week ending July 31st, Wall Street X's and O's. Welcome. Hope everyone had a great week. To kick things off, I'd like to throw out there my required disclaimer that the views and opinions on this show are mine. Any of the information that I do provide is not a solicitation to buy or sell anything. Markets can or investments can and will lose money, and obviously things we talk about are not FDIC insured. So anyway, hey, to kick things off, we've got a busy one here. We're going to hit on unemployment. You say, Craig, you hit on unemployment all the time. Why do you keep hitting on it? It really is going to drive everything that's going on in the economy, and really does that regardless of whether the markets are reflecting that now. It is going to be something that is going to continue to drive what's happening. We're going to look at that for sure. We're going to hit on earnings thus far, on how the S&P 500 on average is doing from an earnings standpoint, because we're in the middle of Q2 earnings. We are also going to discuss performance, sector performance for the week and the month. And then we're going to really dive into GDP, because we had the worst GDP print on Thursday on record. So to kick things off, stating the obvious, we have PPP funds that are being exhausted as of this week. We've got eviction moratoriums ending. We've got loan forbearance programs facing a series of hard stops over the balance of the second half of 2020. Jobless claims are reaccelerating. We have enhanced unemployment benefits expiring, and Congress is acting more like what I would expect from a group of kindergartners arguing and bantering over whose turn it is to swing at recess. I resemble this. It's very much like walking a tightrope along a cliff's edge. It puts us in a real interesting spot, okay? Unemployment numbers, let's dive in here. Unemployment numbers went up. We had another uptick. This is the second week in a row we reported unemployment numbers of 1.434 million. PUA claims, which again are independent contractors, sole practitioners, we actually saw those drop. We got below 900,000 for the first time in 5 weeks. We reported a number of 830,000 and change. Continuing jobless claims went up. We went up almost a million. So last week we were at 16,151,000. This week we reported 17,018,000. That is not good. The weekly unemployment benefit recipients are total recipients. So this includes everything that's going on. We did see a downtick to 30,203,000. But again, people, that's 30 million people on some form of unemployment benefit. This recovery will not continue with unemployment remaining so high. It's impossible. So just know that's happening. On to sales growth and earnings growth for the S&P 500. To date, we've got 287 of the 500 plus S&P 500 companies that are reported. On average, we're seeing sales growth decline 8.32%. We're seeing earnings growth decline 10.72%. So we're seeing some really, really strong challenges from an earnings standpoint. If we get to where we're at month to date, we've had a heck of a month in the markets. We're seeing all the sectors of the S&P 500, in which there are 11, positive except for one. The one drag on the S&P this month is in energy, which it is down 4.36% for the month. Year to date, it's still down 39.71. Energy is really struggling. Leaders, we had multiple. We had several that were really good. We had the communications sector tip the month at north of 6.09. This goes through yesterday, so this doesn't include any of today's numbers. We've got utilities had a big month, up 7.6, materials up 7.01, industrials 4.8, consumer staples 7.03, tech up 3.1, healthcare up 6.07, consumer discretionary up 6.72, and financials closed the month out at 3.8. Year to date, though, we're still struggling. S&P is flat year to date. We have 4 sectors that are positive, obviously still led by technology at 17.5, followed by consumer discretionary at 8.67. Communications services sector is up 6.9, and healthcare rounds it out at plus 4.2. On the negative side, big down, like I said, in energy. Financials, which is banks, credit card companies getting killed, down 21.96 year to date. Industrials are getting hammered, down 11.6 plus. And then you've got utilities and real estate down both north of 6. And the 2 scrapers are materials minus 1.82 and consumer staples down 0.35. Interesting, very interesting numbers. We're still seeing a lot of narrow breath. When I look at the market activity this week, we had a lot of the big names in tech reporting: Apple, Google, Facebook, Amazon, Netflix. All these big companies are reporting. And basically what we're seeing is still very narrow breath. And those are the companies really driving performance on the market. Okay. I think we're continuing to see that. It's what happens after the fact. Okay, because you're not going to have this excitement out there all around what's happening. And again, we've got a few these companies that are the drivers. As I mentioned last week, we've got your big 5 companies: Apple, Amazon, Google, Facebook, Microsoft, make up 40% of the NASDAQ 100 and just a hair over 20% of the S&P 500 in growth or earnings. So it's really something that is not super stable. You'd like to see a lot broader participation, which I've talked about before. On to GDP. Again, we printed the worst number ever this last quarter, of which, and I want to make sure I'm telling you an accurate one. And I've got to look here because, again, my eyes are crappy by Friday afternoon. Second quarter GDP was minus 32.9. First quarter GDP was down 5. Okay. Let's look at the components of GDP. GDP is made up of 4 components. Okay. Personal consumption, business investment, government spending, and net exports. Okay. This really kind of tells us what's going on. All righty. Of that number, 70% of GDP is consumer spending. Okay. If you look at what's next, 18% is business investments, 17% is government spending, and then you round it out with exports. Okay, personal spending is big, and this is where I'm gonna wrap up here and start to wrap it. You know how it is. I start to wrap up and I ramble for 5 more dang minutes. So, and that probably will happen again today, but it's okay. Consumer lending companies, and listen in here. This is some great data. Okay. They tend to be very cyclical, and what I mean by that is this is mainly focused on, it's a credit sensitive group. Okay, the consumer cyclical or consumer lending groups. These are banks and credit cards. Okay, when employment is low, charge-off rates. These means the number or percentage of people that are not paying their credit card or their debts. Okay, on average. This is credit card loans of unsecured consumer receivables tends to run at 3 to 5%. Okay, that's normal. All righty. During periods of stress, loan losses can rise significantly. At the peak of the financial crisis, and this is when it gets good. I love this. Okay, the peak of the financial crisis, charge-off rates reached 10.6. Okay, that's in 2008. Looking back over the last 20 years. The historical relationship is for every million of unemployed or increase in jobless claims, okay, credit card charge-offs tend to rise by 1.7% per million, okay? Right now we're tracking, what I tell you, 17, let me get back here to my stat. I should know this, but 17.018. Which means we've got if you look historically, our credit card charge-off rates right now should be pushing 30%. If you look at from a historical standpoint. I'm going to have a moment of silence and let that sit there. That's big. That's historical norm. Here's where it gets funky. Okay. Right now, Credit card charge-off rates are coming in at right around 3%. Okay. Question is why? Well, here's why. When you really look at what's happening, government stepped up, paying people a lot of money, right? Lots of unemployment benefits, extra $600 per month ends today. Congress, everyone bickering, went home. Gonna go home and cry this weekend, get on Twitter, rip on each other, get on the news, tell how each other's stupid. And you know what? It makes you proud to be an American right now, doesn't it? It's freaking ridiculous. Anyway, here's what's happening, okay? You've got lots of support out there, okay? This brings us to what's happening. On average, when you look at people who are unemployed, all right, when you include this extra $600 per week, and they're looking at reducing it to $200, that's what is on the table right now. It's a $400 reduction. This will reduce earnings of the average person who is out of work right now from $985 a week down to $585 a week. That's a 40% reduction in pay. Okay, that's for over 17 million people. What's more is the plan is for this to just last 2 months before dropping down to 70% of recipients' previous income. This assumes that there's enough, what I would call cowboys left in the reprogrammed state unemployment software, at least those who are cranking this, that are able to basically enable this provision. Here's a couple examples I'm going to put. On average, food service and drinking place workers, so that's bars and restaurants, they earn $390 a week. Okay, that $390 a week has been at $985 per week because of this excess. Okay, that's 150% more than what they were making. That is about ready to get cut to $273 per week, which is a 70% reduction. Leisure and hospitality on average make $427 a week. Child care services, $82 a week. Arts and entertainment, $537 a week. Retail workers, $605. So what this means is that food service workers who saw their income rise by 150% from $390 per week to $985 per week would see their income fall from $985 down to $273. Okay, that's 70% of the $390 that I'm talking about that they were receiving. Okay, normally that's a 72% reduction, and that happens 2 months from now, right? 2 months. Hotel workers' income would fall by 70%, and so on. It's something that doesn't make sense. So as I start looking at charge-off rates, when you start really looking at what is this impact on the economy, because you probably say, I've been pretty negative about what's going on. I really don't think the markets reflect what's happening, and I still believe that. But what's happening is, as unemployment stays high, okay, it's going to put a big time strain on the recovery period of the economy. Going back to the GDP number, again, 70% of GDP is spending. If people don't have the income, okay, they're not going to be spending. Another interesting fact, saving rates have been off the charts. We haven't seen saving rates like this since, you know when? The Depression. Why? People are scared to death. They are either out of work, they're wondering if they're going to be out of work. If they're out of work, they're wondering when they're going to be back to work, and if the government's going to quit fighting and farting around and give them income in which they can survive on. We've never had a period like this in history, but you've got a stock market going straight up. That's where I call the full bull on this thing. That's where I want us to keep our eye on the ball, okay? It's really easy to get caught up in this fear of missing out thing that's happening in the markets. And that's what I don't want you to do. What's my focus on this show is really help you become better investors. I want to help you make good, sound decisions that are based on fundamentals and the math, because that is how you survive periods like this, okay? I'm going to give you a great analogy. It's another Peyton Manning analogy. Being an old quarterback myself, okay? In college, I had one of my coaches say there are times when the best thing you can do is take a sack. Now you may say, Craig, you got hit in the head too much, which I did. Tanya would basically echo that, because there are times when, yeah, I have gotten hit in the head too much. But here's the thing. As an investor, right now, what we're doing is we've taken a sack. What I'm doing for that, it's you eliminate risk, you eliminate anything worse from happening. How do you do that? You really dial in your allocation. What do you own? What do you have exposure to? Right now, we have exposure to TIPS, Treasury Inflation Protection Notes. The dollar keeps going down, inflation is rising. Okay, we own gold. Gold has been fantastic. Okay, we own commodities. Commodities are waking up from the dead after 10 years of being dead. Okay, we own tech, which tech is a good thing to own when you have growth going down and inflation going up. Okay, we own the right things, but in the midst of that, we have times when you're feeling like you're left behind. That's when we're taking a sack. Okay, so I want you all to hang in there. You know what? It's going to be okay. We're navigating through this time together, and I'm actually very optimistic about what's coming. As bad as it can look from a macroeconomic standpoint, I feel very good about how we're allocated. I feel very good that we're staying focused on the ball. You always got to focus on the ball, okay? Baseball's getting fired up again. Go Rocks. It's like a hitter. You focus on the seams. You try to pick the seams up out of the pitcher's hands, which then can dictate what pitch is coming at you. That's what we're trying to do right now. We're trying to pick up the spin of the ball and pick up the seams, okay? So in closing, I appreciate everybody. You guys are great. I love you guys. I hope that this is really helping. I want you guys to keep focused on the ball. I want you to know that there are times when it is okay to take a sack, okay? And focus on getting your arms around where we're at, what's going on. We've got to breathe and we have to focus, okay? So for Friday, the last day of July, July 31st, live from Lawrence, Kansas, Rock Chalk Jayhawk, baby. This is Craig Modelmog, and I am out.